Well, today Australia saw its first interest rate cut in 5 years. However, the market was less than enthused and ended up finishing firmly lower. So hi there everyone, welcome to the Traders Circle weekly market update. Today is Tuesday the 18th of February 2025, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So like I said, we got an RBA rate cut. This had been long expected by the market. It had been completely priced in by the market. And, as a result, it wasn't so much today about the rate cut itself. Like I said, the market was convinced it was coming. It was more so about what the RBA said about potential future rate cuts. And in that regard, the market was disappointed. The RBA basically said that there's a risk in cutting too quick from here, and the risk is that inflation settles above their target range. So they basically indicated that they're going to do this rate cut, and then they're going to see, what inflation does from here, whether it keeps falling, whether it stabilizes, or whether it ticks back up. That's not what the market wanted to hear at all. They really wanted to hear that this was the start of a cutting cycle, and that basically we were going to see cuts at the next few meetings as well. As a result, the market actually sold off a little bit after the rate cut was announced. It might be surprising to some, but you've got to keep in mind that we did rally in the lead up to this rate cut as we priced this cut in. We've now probably seen the market start to price out a few, future rate cuts that they had already priced in ahead of today's meeting. The RBA's decision, to be a little bit more hawkish in their statement shouldn't be too surprising though. Keep in mind that underlying inflation is still above the target range, and it certainly hasn't fallen like the headline number has. The headline numbers received boosts from things like the energy rebate that the federal government has given, and also from volatile items that have perhaps fallen for the short term, but that might go back up. Underlying inflation is still quite sticky, and we have seen US inflation tick back up a little bit in January, and I think the RBA is looking at that US inflation as well, and they're worried that we could also see a little bit of a tick back up at the next reading as well. I think they have every right to be a little bit concerned in the short term about a little bit more inflation coming back in, and there's a lot going on around the world, and I'll touch on that a little bit later. But a lot of those sort of global events could lead to further inflation. And I'm talking about things like tariffs being announced, potentially a breakdown in existing global trade systems, geopolitical uncertainty. All of those things could contribute to further inflation in the near term. And I think the RBA is right to take a cautious approach, even though it did perhaps disappoint the market a little bit. We're also in the midst of a company earnings reporting season here in Australia. It's February. It's one of the two big ones of the year. We've got February and August as the two big ones. And so far we've seen quite a few large companies report earnings. What I would say is that the results have been mostly a bit disappointing so far. We saw CSL fall strongly after its report. BHP was pretty much flat today after its report. CBA did push up initially, but it came right back down. IAG fell very strongly. Bendigo Bank, another of the bank reports, fell off very, very strongly. And overall, I would say that probably a bit more negative this season than positive. That shouldn't be too surprising though either, because our market is at its all-time high, and it's also at its all-time high valuation level. And what I mean by that is prices relative to earnings are the highest they've ever been. Our dividend yields are some of the lowest they've ever been. And so for our market to keep rising, on the back of an earnings season when prices are this high, we need the results to be outstanding. And they haven't been outstanding. Our market will probably earn less this year than it did 2 years ago, yet we're 20% higher in price. We're probably going to see less dividends this year than 2 years ago, but we're 20% higher in price. So it shouldn't come as a surprise that, in general, the average report leads to a bit of disappointment in the market. Plenty more earnings to come. Obviously, things can change. We could see some surprises to the upside, no doubt. I'm sure there will be, but I'm sure there'll be plenty more surprises to the downside as well. we will see reports all until the end of this month, and then we're going to see plenty of dividends come out of the market over the next month as well, and that will reduce the market's level as well. I believe there's about 40 points of dividends over the next 6 weeks. Finally, we've got global uncertainty. Obviously, we've seen Trump become president in the US, but there are other factors at play as well. We've seen a bit of political uncertainty in Europe. We're going to see some further elections there, and a lot of the things that are sort of being discussed and bandied about, the market doesn't really know how to respond to. The market quite rightly doesn't like tariffs, and it shouldn't like tariffs. But when Trump announced the tariffs, there wasn't really much of a strong response. And then he has announced that some of those tariffs are going to be paused, and the market's really applauded that. So if some of those tariffs are brought back in, we could probably see further selling. And yeah, there's going to be a lot to weigh up from the tariff front. There's also a lot going on in Ukraine. I think European markets overnight took a bit of a view that the Ukraine war is closer to a resolution, and they jumped on the back of that. Again, I'm not so certain because the deals being suggested don't really suit the Ukrainians. I know they're sort of up against the wall, but it seems like they're being extorted a little bit with some of the terms that are being suggested. It could be that the countries in Europe, the other countries in Europe, have to step up to the plate to try and ensure a fairer outcome for Ukraine, and that might lead to an extension of the war. Who knows? But I don't think that the terms that the Americans are proposing are really terms that the Ukrainians will go for. They seem more like appeasement to Russia than anything else. Outside of that, there's plenty more global uncertainty. I think that just in general, the breakdown between the US and its allies around the world, the tariffs, and plenty more to go on about, to be honest, with the current US government. So with that uncertainty, we have to see it through the lens of markets being at all-time highs. The all-time highs have been driven by extreme levels of government spending, and those, that government spending, those levels of spending aren't really going to change anytime soon. And so I think markets will in general hold up, but we are prone to shocks. Given how expensive things are, there is a fair likelihood of big shocks to the downside on individual bits of news. And I suspect that's probably what we're going to see for the next few months. So do be aware, we could see spikes of volatility here and there. So let's have a quick look at the charts for this week, guys. This is the Australian market, the XJO, and we can see that we did see a bit of selling today after the RBA decision, even though it was a rate cut. That has probably broken us out of this short-term uptrend, and it's held us below the key resistance level, the all-time high resistance, right around sort of 85.50. With the break of that triangle to the downside, we'd probably expect to move towards a previous resistance level, which may hold as support. Now I'm looking at 83.70 as a potential downside target. If that level breaks, or if it takes us a while to get there, then we're starting to look at the longer term uptrend. And if we were to hit that today, probably around 8300, but by the time we get there, it might end up being right around that 83.80 level. As I mentioned, there's extreme amounts of government spending around the world, and all of that is flowing to financial markets. So as long as those spending taps are kept on, I would expect these levels to hold, and we'll probably bounce up from there. But like I said, in the short term, with a bit of negativity, I wouldn't be surprised to see us drift down to those support levels. So let's have a quick look at the US markets. And this is the US S&P 500. It's also stalled out at its own resistance level, right around 6120-ish, 6115, maybe a little bit above it, and it's also inside an ascending triangle. If they do hold the resistance here and pull back a bit, we're then looking at a move towards the uptrend line here. And depending on how long it takes them to get there, that should be about 6,000 or maybe a little bit above it. In general, though, we would expect that triangle to hold, at least until it gets closer to the point, and then possibly a break higher as long as there isn't, strong negative news in the short term. And that is the key point. The default setting for the market at the moment is gains. And like I mentioned, lots of government spending, potentially even expected corporate tax cuts in the US, and all of that is driving prices higher. They are extremely expensive though, and they are prone to short-term shocks to the downside. So if we do see a shock lower, if we do see a downside breakout, it's probably going to be on the back of some sort of negative news event, a tariff announcement, a trade war, potentially an escalation in a conventional war. We'll have to wait and see, as those events pan out, but markets are vulnerable up here. They're not super resilient given how elevated prices are, and given how, there has been a build-up of negative news. Both, US earnings reporting has been pretty poor, the same as our own. The tariff announcements aren't great, and perhaps the breakdown of the US-European alliance isn't particularly great either. So I will wrap it up here for this week, guys. Things are perhaps looking a little bit negative with prices this elevated. And it will be very interesting moving forward nonetheless. So hopefully you guys enjoyed. If you did, give us some love by clicking like, clicking subscribe, and we'll see you guys next time.